up, everybody? Good morning. Welcome aboard. It is the Trading with Bubba, and what's going on? Markets are kind of scary today. It's Halloween, and not a lot going on. It's kind of quiet, which makes it even scarier. As we look just at the quick look at the futures markets, the Dow is kind of trying to rally a little bit, but virtually unchanged in the day. The Russell's trying to spike up, which is interesting. Yesterday, with the big rally, it did not participate. And now maybe here it is after getting hammered. We look at the IWM. Again, we'd like to be buyers of puts or sellers of call spreads, somewhere around 167 or so. If we can rally back there, I don't know if it'll get there or not. It's always a question. One of the things the markets are missing the most here is action and activity. The participation is really low. The volume is really light, so it makes it much more challenging. The NASDAQ is, been on both sides of unchanged this morning. The S&P also on both sides, but both are higher. Right now, all four markets are slightly higher, except for the Russell, which is up sharply for the Russell. Crude oil is a little bit higher. Euro currency is a little bit lower. The notes are a little bit higher, and gold is higher. It's really a quiet, dull market-ish. There isn't a lot to do, and of course, one of the biggest things you can learn as a trader is to be more patient and learn how to observe the markets instead of always thinking that you have to be involved in the markets. There's a big lack of activity. We have earnings coming out this week. At Apple, for example, very, very much just hovering around 170. What does that mean? Well, it doesn't mean a lot, except that probably, there's going to be a bigger move. And I know that Apple's pricing in about an 8% move when the earnings come out. Let me see if this thing's squared away. There we go. Apple's pricing in about an 8% move. Right, the earnings are this week, okay, and it's telling you that it's going to move, okay, and again, it looks like, probably around, like I said, around the 8% level, so there's not a lot of real excitement to the markets. Volatility is fairly light, and I think that, again, these are things that you watch, which kind of determine activity as to what we're going to do in the future. Now, as we look at the markets, they look pretty ugly in a bigger picture, but that doesn't mean it's going to be ugly today. Again, you look at Amazon, which had solid earnings, popped a little bit, trying to break out back to the upside. Okay, you look at Google, which had rotten earnings and reached a secondary resistance level after the break. And again, you just have to kind of pick your spots. And I think one of the mistakes that traders make is they feel compelled that they have to always be involved. Now, you can make a lot more money by sitting out and waiting for your opportunities. We expect a rip your face off rally, a dead cat bounce. When it comes, okay, it's better to be on the sidelines and be able to react to it than to try to guess when it's going to come. And I think that is something that is important for all of you, is to realize that you can make more money sometimes than by trading less. There will be a time when active trading will be the trade to make, and there's times when passive trading. And I think right now, based on the overall activity, we're more in a passive environment. We just go through a number of stocks. Look at Meta, for example. Meta, which is the old Facebook, it's just stuck in like a consolidation range, not going a lot of places. GLD is kind of stuck towards the upper end of the range, not going a lot of places. Microsoft stuck between 320 and 340, not going a lot of places. Nvidia coming back off, and again, held the 400 and is holding, but really not going a lot of places. So, the Qs, not going a lot of places. Square Dance, which has earnings this week, not going a lot of places. So again, you got to remember, where is the benefit for you? If you understand that we are trading a pure probability model, okay, and if the probabilities are not in your favor, then there's probably not a lot for you to do. And I think that is something that you have to recognize as a trader, as an investor. What's the right environment for you to be involved in? And as we watch currently what's going on, it's kind of like you want to take a nap. There isn't an overabundance of activity. There isn't an overabundance of two-way price action. There's really just a orderly, non-moving market that is not really creating a tremendous amount of opportunity to trade. So I will always tell you, it's easier to not trade when you don't see a dramatic edge versus trying to force or jump into a trade. I'm going to go back on and pull up these charts here, and I'll bring you back in here, and we'll see if there's anything that's worth looking at on a short-term basis. So as you're looking, for example, maybe the euro currency is a potential buy. Maybe gold is going to be a potential buy, on what we would call the blow-off pattern to the downside. But then you have to make the decision, is there enough overall business for us to want to get involved? And to me, I would say the answer is probably no. I don't see enough dramatic activity that says that I want to be involved. I've got areas and levels picked out that I want to sell. And I think when you learn that part, you don't have to make an exception on price. If you recognize that the markets are open 241 days a year, you recognize that they're going to be there every day. So doesn't it make more sense to sit back and wait for your opportunity and wait for what you're looking for instead of settling? Okay. Too often traders settle for something less. And of course, then most likely they are forced to make a decision as to close, get out, get puked out. Again, nothing good ever happens by trying to outguess the market and where it's going to go next. And I think when you learn how to wait for it and how to wait for your opportunity, I think you make a lot more money. It also gives you a lot more control of what you're going to do. And I think that's the importance of what we want to look at is having control, because what are we really controlling? We're controlling our emotion. Okay. Emotions have hurt more traders over time because we get too emotional about what's next. And I think that it's important to understand that that is not a good thing. That is a bad thing for us. And if we learn to control that emotion, it will give us a better chance to be successful over time. The strategies we use are fine. But again, if you're banking, whether you're selling call spreads or whether you're selling put spreads, whether you're selling options, whether you're buying options, you still have to be in the best position to make money. Okay. There isn't an excuse to make a trade because you think you should be making it, or you say, well, it's a high probability trade based on what the options model tell me. We know that those risk graphs, all the other crap is really worthless because it doesn't really tell you the true effect of the market and is only using back information versus, well, how do you foresee the market forward? And if you look at the chart, right, you're trying to use whatever time frame you're using, but we'll use the spiders for now. So if I'm looking here, okay, so what am I really looking for? Well, I can clearly see that the trend is lower. Okay. So if I can clearly identify a lower trend, which means that what would my next trade want to be? My next trade would want to be, I'd want to try to be a seller somewhere. Okay. So if I want to be a seller, where do I want to sell it at? Well, do I want to sell it right here? Which is, the first logical spot would be, let's say 417. Do I want to be a seller at 417? And in the current market environment, I probably don't want to be a seller there because there's probably more room to run. And I'm dealing in a very dull market right now. Okay. And dull markets have a higher tendency to move a little bit higher than they do to move a little bit lower. Now, it doesn't mean that it wouldn't work, but the question is not, did the trade you put on work? The question is are you confident and are you comfortable with what can go wrong at that price? And I think that is something that we have to recognize on a regular basis is, am I comfortable with the trade? Am I comfortable with the amount of risk that I'm going to have to take to carry that trade? And that's where many traders will fail, is they're not comfortable, but yet they get involved and make trades that are probably not very good to begin with. And I think that is something that you have to start to recognize as a trader, is it's better to wait for your opportunity of something you're looking for instead of making an exception to get in to a position before it's time. Okay. And again, all you do is really read the market footprint. Okay. And again, I'm looking for 420 and the spiders to get short. I'm looking for 167 in the IWM to get short. And again, when I get short, it'll either be by selling call spreads. Very rarely will I buy a naked put or a naked call. I think you're giving up too much of an edge when you do that. I think if you learn how to sell wide spreads and in the money spreads, you're actually creating the other side of that trade anyways. So I think that it's something that is important, to you as you look and start to trade this. But again, so you look at the Qs. Where am I looking at? If I'm looking at the Qs, I mean, certainly if you told me you're going to sell at 350, I couldn't fault you for selling 350, but I think there's more to go. And the question is, can you hold the pain from 350 to 355? Okay. And of course, remember, if you're buying options, then the options you're buying are probably getting destroyed on that if they get to 355. So then it's easier to sell a spread. But again, I think in the current condition of the market that you're much better off waiting for your price. Okay. And in case right today, I'm giving you prices that I like and I'd like to sell, because we do know there is earnings plays coming out. There is news coming out. You've got the FOMC tomorrow. You've got the jobs on Friday. So there is a lot of news that will drive these markets this week as well. So why should I try to be overly active in a market that doesn't really want me to be overly active? I think that's another story that we have to remember. Okay, is where are we in the overall picture of the market, and what do we expect? What are our expectations based on what is the footprint? So we know that the Qs have found pretty solid support at 342, and we're showing some resistance at 350. Okay, but if they pop through there, then they can easily go to 355. And that's, again, what I want you to start to recognize is the bigger profits will be made when you can sit back and wait for your opportunity to let the market come to you and the levels. There's an old saying, it's much better to wish you were in a trade than to wish you were not. Okay. So I think when we look at, again, it doesn't matter what we look at coin. Coin is stuck in the middle. Now, coin's got earnings. I don't know if it's today or tomorrow. Tomorrow, I think. Okay. Again, there's nothing really to do here. What trade would you possibly make here? Okay. Whichever trade you make, you're making a guess, because you can see it's clearly in the middle of nowhere. Okay. So why would I want to try to make a guess when something is trading in the middle of nowhere, when I can clearly wait until it reaches a support level or a resistance level to participate? Because quite frankly, if I look at this on a bigger scale, it's kind of telling me that there's a much bigger move coming. Okay, so I have to wait for it though. And if I don't wait for it, then if I'm not right, then I could make a bad decision. Okay. And remember, successful trading is successful because of a group of decisions that you're going to make through time. Successful trading comes when you're putting yourself in the best position to be successful, so that you take out the panic decision, you take out the emotional decision. You have to be in trading, you have to have as little as emotion as possible, because overall, the more emotional you are, the more likely you are to make a bad decision. Okay. And we're not here to make bad decisions. We're here to make the highest decisions of the highest probability to give us the best opportunity. Okay. If we don't do that, then we're all we're really doing is flipping a coin for thousands of dollars. Now, I don't think that that's what you're trading for. I think that you're here and trying to figure the best ways to make the most amount of money. So again, it really just comes down to the market footprint. As we look, and we're going to go back to the very short-term charts and just see anything happening. And of course, there's really not much going on. And this is, again, another story of what we're watching is there's really not much happening. So if there's not much happening, it makes it much more of a challenge for me to say, oh, I really want to make that trade, because why would I want to make it? Okay, what guess do I want to make? Okay, and of course, when you start to guess, what comes into play? Well, then your opinion comes into play, which is something that was developed because you read something in the Wall Street Journal or because you saw something on the news. And again, these things, you may think that I'm full of crap, which, listen, you won't be the first one, but these are things that make the difference between being a good trader and a lousy trader. Somebody who has a chance to survive and make money in this business, and somebody who doesn't. Okay, because again, when we come down to it, it comes down to your understanding of what the market footprint is showing you, and showing you what is the next most likely thing to happen. Now remember, anytime you're playing in a mathematical or a probability model, there's no guarantee that the next move is going to be correct or according to what you think, but you're talking about decisions over time. Okay, you're talking about what we call the law of large numbers. You're talking about the ability to put yourself in a continued position that will give you a successful opportunity to move forward. Those are the things that you have to remember. Again, it's nothing about what you know about options or stocks or futures. The first part you got to work about is in here. Okay. The first thing you got to do is look in the mirror and see who your worst enemy is, because that is your worst enemy, because the person who makes an emotional decision is most likely to fail. Okay. You cannot let the emotions, which is why we talked consistently about, it's all about the market footprint that they're leaving for us right now. Okay. Because we cannot take anything and put ourselves in jeopardy if we are playing purely a numbers game. Okay. And trading is strictly about the numbers. Okay. A, it's about the profit and loss. B, it's about reading the chart. Okay. But if you don't get the beginning part right, okay, which is the emotional side inside of you, then you can't get any of this right. Because every trade you make will have something to do with an emotional imbalance that you are playing with. And again, I go back to what's the point? Why should you be an emotional trader when it's purely about the numbers? It's purely about where I can put myself in the highest position of probability. Okay. And again, like I said, they're all the same. It doesn't matter what chart. Here's a 4 minute, here's a 1 minute. Okay. It doesn't matter what time frame you're using. The footprint in each time frame will tell you. And again, if you're willing to put yourself in that position with the footprint, and you're willing to live with your decision, okay, and that's the other part, right? It's hard because by human nature, we get ourselves an opinion either because we're reading something, because we can see what's going on in the overall economy, for any number of reasons, make you formulate an opinion and want to put you in a position in the market, which is typically going to be wrong. Okay. So if you can put yourself in a position to purely look at the chart, read the chart, give yourself the best opportunity, that's what you should be focused on, because you know that there's going to be a wild afternoon tomorrow. Okay, we already know that. So do I want to carry a big position into the FOMC meeting tomorrow? Okay. And if you say yes, why? Why would I want to carry a big position when I know an item is coming out that will have as much impact as some of the earnings reports do? Okay. Do I want to have a big position going into, Friday morning, okay, when the jobs number comes out? And the answer should be no. Remember, you can make and will make more money if you are prepared, okay, to react to the market and the movement afterwards than you will if you have a position on beforehand. Because I'll tell you what happens, and tell me if I'm wrong. Okay, you have a position on it, maybe you're right, but you take the profit so fast, you miss most of the move because you're too busy taking the profit because you're concerned and you want to make sure that you get it right. Well, I have no problem with trying to get it right, but I do have a problem with when you decide that you grab your profits too quickly because you were in the position too soon, so you're taking the money too quickly. Again, it's a whole series of chain of events that happens to traders. Okay, and I think that you have to take in stride. Okay, but the more of your emotion you can eliminate away from the market, okay, the more you can become more robotic at just looking at a chart, okay, and saying, okay, so let's see, this chart tells me that I should be doing what? Well, this chart tells me I should be doing nothing, okay. And again, it doesn't matter what it is, okay. This chart tells me I should be doing nothing, okay. This chart tells me that maybe I should look for a rally to sell, okay. And again, you can go through them piece by piece, and I would urge you to start practicing and using to look at, not to trade off of necessarily, but to practice off of 1 minute charts. And the reason I talk about 1 minute charts is just because those will give you the fastest read and learn about the market movement, because one thing we know for sure, all charts are the same and all patterns are going to repeat themselves. Okay. So if you learn to recognize those patterns, you can learn them faster on a 1 minute cycle than you can on a longer cycle. Okay. So I'm encouraging you to start to practice. Okay. And then you can pick the time frame in which you're going to trade off. But you should also have a time frame in which you're going to trade if you're going to be more active, because it has to be consistent. Remember, one of the big things about trading is consistency as well. Okay. And those are things that we have to consistently, a little redundant, that we have to always remember. Okay. Again, our number one job is to put ourselves in the best position. Okay. So how do we do that? We become consistent. We do the same things over and over again. Okay. Which includes knowing where our exit is when we're wrong. Okay. Because again, not every trade is going to be a winner, and we know that some are going to be wrong. But we have to be consistent so that we know what to expect, and we do not let our emotions take over for us. I think that is something that is extremely important for all of you to remember. Okay. And I think that we have to, take that memory and ingrain it into our trading model. Okay. Which comes back to a plan. In fact, on Thursday, we're going to go through building a trading plan. But for today, I got to cut it a couple of minutes short. But have a great Halloween, and we'll see you back here on Thursday with another Trading with Bubba episode. I hope you enjoyed it. I hope you learned something. Make sure you subscribe. And remember, check out Tradier Brokerage. Have a great day, everybody. We'll see you on Thursday. Enjoy Halloween.